All right, so you're thinking about index funds, huh?
Mhm.
Wondering if they're really as good as everyone says. We're going to do a deep dive today and cut through all the hype. We'll figure out what's really going on with index funds.
Yeah, and the analysis from documento.txt is really interesting. We've got some great data to dig into today.
Yeah, perfect.
Hmm.
I think most people, when they hear index funds, think, oh, set it and forget it, right? But
Right.
then you start thinking more and you're like, wait, with inflation going crazy, can index funds actually keep up?
It's a big question for sure. And
Yeah.
documento.txt actually tackled this head on. They used 24 years of real inflation data from Spain's IE, that's their national statistics agency. And over those 24 years, total inflation was 7.5%.
Okay, so 7.5% over 24 years, it doesn't sound too bad.
Yeah, you're right. It doesn't sound too bad. But here's the thing. It averages out to about 2.3% annually. And that's where that compounding element can really sneak up on you. Even if it's a small percentage each year, over time, it adds up. Think about it this way. If your returns are only slightly higher than inflation, it's kind of like running on a treadmill. You're putting in the effort, but you're not really getting ahead.
Yeah, that's a great analogy. So how does this actually play out with index funds?
Well, Documento.txt looked at the MSCI World Index as an example. Basically, it tracks a bunch of global stocks. And since 1987, it's returned on average 8.67% annually. And importantly, that's compounded.
Wow, 8.67% compounded annually. That's a pretty impressive number. But we got to factor in that inflation, right?
Yeah, you got it. Documento.txt factored that in, and even after adjusting for inflation, the return is still really good. It shows you the power of compounding over time. They also compared it to keeping your money in a regular savings account, and, well,
I bet there's a big
let's
difference.
just say it's a significant difference. You're actually losing purchasing power over time with inflation eating away at your savings.
So it's not just about making more money. It's about making sure your money's keeping up with or beating the rising cost of living.
That makes sense. Okay, so index funds might be a good way to beat inflation, but what about, like all the ups and downs in the market? Index funds mean you're along for the ride, and sometimes that ride can be a little wild.
For sure, and Documento.txt actually looked at that specifically. They look at how long your investment might be underwater.
Underwater.
Yeah, basically how long it takes to recover from like a market downturn.
So even though index funds are generally going up, there can still be some like rough patches.
Exactly. Documento.txt used the S&P 500 as an example, and it has a long history of growth, but also some pretty big dips.
Yeah.
And get this, they found that if you had invested right before the dot-com bubble burst in 2000, it would take 13 years just to break even.
13 years. That's longer than some people have even been investing. I see why people worry about volatility. Yeah, it's totally understandable, but that's where having the right strategy is important. And Documento.txt outlines a few ways you can kind of mitigate that risk.
Okay, like what? What can people actually do to deal with those market swings?
The first thing is dollar cost averaging. Basically, you're investing a little bit at a time on a regular basis instead of putting all your money in at once.
Right.
That way you're spreading out your risk and not buying everything at the peak of a bubble or at the very bottom.
Yeah, that makes sense. You're not trying to time the market perfectly or anything.
Exactly. Another thing Documento.txt talks about is understanding market cycles. Like, historically, if you look at it, periods of decline are generally followed by periods of recovery.
So even when it feels scary, historically, markets tend to bounce back eventually.
That's right. And then for more experienced investors, Documento.txt mentions leveraging during downturns, but that's definitely a more advanced strategy.
Yeah, it sounds like that one comes with some risks. So you
Yep.
probably want to know what you're doing with that one.
Exactly. It's not for beginners.
So we've got dollar cost averaging, understanding market cycles. Anything else?
Oh, and of course, diversification. Don't put all your eggs in one basket. Documento.txt even mentions Ray Dalio's all-weather portfolio.
Right, the classic advice. So we've got dollar cost averaging, understanding market cycles, diversification. These are all ways to deal with that roller coaster ride. But what about fees? Don't those eat into your returns? And what about taxes?
Yeah, those are common concerns. But Documento.txt points out that index funds are known for having low fees, often much lower than actively managed funds.
Right, because you're not paying a bunch of people to pick stocks, you're just tracking the market.
Exactly. And on the tax side, well, it's not as simple as your income tax. Capital gains are taxed differently and usually more favorably.
That's good to know. But what if someone makes a lot of money? Like, what if they have a huge win? How do taxes work then?
That's where strategy comes in. Documento.txt actually gives a couple of good tips there.
Oh, yeah, like what?
One thing is to sell only what you need. Don't cash out everything at once because then you get hit with a huge tax bill.
So like a gradual approach, especially for those big wins.
Right. Another strategy is borrowing against your investments.
Borrowing against your investments. That sounds kind of complicated.
Yeah, it's definitely more common with like high net worth individuals, but documento.txt does a good job of explaining it.
Okay, so we've covered a lot of ground here. We talked about how index funds can potentially beat inflation. We looked at some ways to handle volatility, and we even touched on minimizing fees and taxes. What else did Documento.txt have to say?
One of the big things they emphasized was having an emergency fund, especially with the market going up and down.
Right. Having that safety net can really make a difference when things get a little uncertain.
Exactly. And you know what? Documento.txt actually ended on a really thought-provoking note.
Oh, yeah. What's that?
They said that the biggest risk might not be the market itself, but not investing at all. Because if you're just letting inflation eat away at your savings year after year.
You're losing ground even though it feels safer.
Exactly. So it's all about balance, right? Figuring out your own risk tolerance, what you're trying to achieve, and making those financial decisions work for you.
Totally. So to wrap up today, we learned that inflation is definitely something to keep in mind, but index funds have a pretty good track record. Volatility is out there, but we talked about ways to manage it. And of course, we can't forget about fees and taxes.
It's all about being informed and having a plan.
Absolutely. We hope this deep dive gave you a better understanding of index fund investing beyond all the hype. Think about what really stood out to you today. What other questions do you have? Keep learning. Keep digging deeper, and most importantly, make those financial decisions work for you. That's it for today's deep dive. We'll catch you on the next one.